Good evening, everyone. Thank you for joining our final Corporate Connect session for this year. I'm Sunny, your host for today, as well as the moderator. This evening, we welcome First REIT as well as our audience from Facebook and Momo Live. This webinar is organized by SIAS and supported by SGX Group. We will kick off today's webinar with a presentation by Ms. Jihe, Research Analyst at SGX, on resale market highlights, followed by a corporate presentation by Mr. Victor Tan, CEO of First REIT. And we'll end off this evening with a Q&A session. First REIT is Singapore's first healthcare and real estate investment trust, listed on SGX on 11 December 2006. First REIT is managed by First REIT Management Limited, which is 60% owned by OUE Limited and 40% owned by OUE Lippo Healthcare Limited. Over the years, First REIT has successfully built a high-quality and diversified asset portfolio of 32 properties comprising of 15 located in Indonesia, 13 in Singapore, and 14 in Japan. The stable income producing portfolio covers the full scale of healthcare real estate, including hospitals, nursing homes, and other healthcare-related facilities. As of 31st December 2022, First REIT properties are collectively valued at 1.15 billion, and developed markets comprises of 28% of First REIT portfolio. First REIT targets for developed market to comprise more than 50% of its portfolio by 2027. Without further ado, I will now invite Ms. Jihe to give us an overview of how the REIT market is performing right now. Over to you, Jihe.
Thanks, Sunny. First off, I'd like to share my screen to begin with. There we go. All right. Well, thank you everyone for taking the time to join us on this Tuesday to attend this webinar and to hear from Singapore's first healthcare REIT, First REIT. But before that, I'd like to provide some context, a little bit of background information with some of the highlights from the Singapore stock market today. So my name is Jihe Lee. I'm a research analyst at the Singapore Exchange. So to start by giving you an overview of the Singapore REIT and property trust market, as most of you know, the Singapore market has a total of 42 REIT and property trusts, and that has a combined market value of 86 billion Sing dollars. This represents 12% of all listed stocks in Singapore, and these S-REITs have an average dividend yield of 8.2%. They can be divided, if you look on the to the right-hand corner, they can be divided into property subsegments. They include industrial REIT, hospitality REIT, retail, office, healthcare REIT. The list goes on. So you can really see that the Singapore REIT market, as well as the business trust market, has a very diversified portfolio. It also has exposure to not just Singapore, but these REITs manage a portfolio of properties across the entire continent of Asia. Outside of Singapore, the sector includes 11 China trusts, 11 Japan trusts, 5 in Malaysia, and 4 in South Korea. And now S-REITs are in particular popular because of their attractive dividend yields. They're mandated to distribute at least 90% of their taxable income to shareholders, which results in very attractive and consistent dividend yields. And retail investors are offered attractive dividend yields compared to government bonds and fixed deposits. And REITs are also known for their stability and the fact that their dividends are tax-free. So as you can see here, the average dividend yield from the 42 S-REITs and property trusts clearly outpaced that of the yield seen on the Straits Times Index, the 10-year government bonds, as well as the Monetary Authority of Singapore's core inflation rates. Now, looking into the breakdown of each sector within the S-REITs and property trusts, this is from the SGX's REIT chart book that we publish every month. The office REITs have in particular been a leader in dividend yields recently, and this comes despite these headwinds that we've seen over in the US market, especially that news of WeWork filing for bankruptcy, possibly. But with the recovery in office REITs, we think it could be due to more companies are issuing return to office mandates rather than allowing the flexibility to work from home. And and as it was during the COVID period, and this is also followed by retail REITs, that includes shopping malls and such, as well as diversified REITs. Comparatively lower than the subsegments here down below, we see would be healthcare REITs, possibly due to COVID being declared by the WHO an endemic, and perhaps less focus on the healthcare sector overall in the market. Although we have seen a resurgence in COVID cases in Singapore recently, so perhaps worth keeping a closer eye on that. Now, in terms of total returns that we've seen so far as of yesterday's close, if we were to compare the Singapore REIT market average in total returns in comparison to Hong Kong's REIT market, we're seeing, despite the volatility and turbulence that we saw throughout the year of 2023, the Singapore REIT market actually turned positive as of December, as you can see that uptick towards the end of this chart here. Worth noting is that the iEdge S3 index declined nearly 9% in total returns for the first 10 months. So you can really see that decline continue up until October. And then that really picks up in November, as we've seen with market expectations over interest rates, especially signals from the Federal Reserve peaking. This was the sector that truly outperformed S-REIT in Singapore, marking the best month that it's seen in 3 years. It marked 7.4% in total returns. And especially after the recent FOMC meeting, where Fed Chair Jay Powell really boosted further hopes of big rate cuts ahead for 2024. So according to the CME Fed Watch tool, the first cut that's actually expected, investors are pricing in nearly a 70% chance of a 25 basis point to come as early as March next year. So if you look at the probability spread throughout for the full year, markets are actually pricing in about 60%, are pricing in a rate cut of more than 150 basis points or more. So we're definitely expecting the S-REIT sector to benefit from that. Sorry, one more thing worth noting is that now the total return stands at 3.1%. So if you were to compare it with the Hong Kong REIT index, it's seeing nearly, rounded up, that's nearly 30% negative in total returns as of yesterday's close. Of course, we know and we've heard of lots of hurdles within the Chinese property market. And so the next question is whether or not the Chinese government will really be stepping in to provide, pump in more cash to this ailing sector in China. Over at the SGX, we also look at fund flows in terms of net institutional as well as net retail inflows. The day after that December Federal Reserve meeting, institutional investors net bought 12 million Sing dollars worth of S-REITs just on the 14th of December. And on a December month-to-date basis, as of that day, institutional investors net bought more than 29 million Sing dollars of the sector by that date. And that sector has been seeing monthly net institutional outflows since February this year, as you can see in this chart. Worth noting is that the largest net institutional inflows in December were seen from CapitaLand Integrated Commercial Trust, Maple Tree Industrial Trust, and Suntec REIT, which would be a total of 39 million Sing dollars. There were two S-REITs which saw net inflows from both institutional and retail investors, and they are Paragon REIT and Savannah Industrial Trust. And also worth noting from a fundamental perspective, while rising interest rates, of course, puts pressure on REITs gearing ratios, S-REIT managers have been actively managing balance sheet exposures. 17 S-REITs have seen a drop in gearing ratios since the end of 2021, averaging a 3 percentage point drop. And among those that saw higher gearing ratios, they averaged a 4 percentage point increase. And currently, 26 S-REITs maintain gearing ratios below 40%. And last but not least, another part I'd like to highlight as we look ahead to 2024 not just the REIT itself and the property trust, but there are ETF products that track REITs and its performance, and they are also seemingly in focus. There are 5 REIT exchange traded funds or ETFs listed in Singapore. They've averaged about 7.2% in total returns for the month of November. The 5 REIT ETFs, in order of assets under management, they are quite a mouthful. They are Nikko AM Straits Trading Asia X Japan REIT ETF. There's the Lion Phillip S-REIT ETF, the CSOP iEdge S-REIT Leaders Index ETF, the UOB APAC Green REIT ETF, and the Phillip SGX APAC Dividend Leaders REIT ETF. So in total, the 5 REIT ETFs, they have a combined AUM exceeding 840 million Sing dollars as of the end of November, more than doubling in size in 3 years. And these 5 REIT ETFs, they've recorded 11.5 million in net unit creations for the month of November, when S-REITs really saw that uptick. And this comes after REIT ETFs took over gold and fixed income ETFs, especially with investors turning to safe haven assets such as gold and fixed income. While we've seen a lot of global slowing throughout 2023, we're seeing that investor sentiment really shift over to perhaps growth stocks and REIT and such. So now it is the second most traded ETF asset class by retail investors as of the 3rd quarter of 2023. And so much of this performance has, predominantly been driven by expectations of rate hike cycles, potentially nearing a dovish pivot ahead, and will most likely the S-REIT sectors would be the beneficiaries as we see if market expectations uphold for that big steep rate cuts ahead for 2024. And with all of that considered, there's definitely lots of investment opportunities here with the upcoming year. This concludes the market update session for today's Corporate Connect webinar, but you can scan this QR code if you want to follow for more market updates from the Singapore Exchange. And you can also visit fgx.com/research. If you have any questions on any of the above mentioned material from today, feel free to drop me an email or contact SIAS. You can also subscribe to our Telegram channel here. We also produce these reports called REIT Watch and part of the Business Times for further details that I've summarized today. Thank you so much for your time. I'm looking forward to hearing more from Victor and excited to hear what he has to share about Singapore's first healthcare REIT. Back to you, Sunny.
Okay, thanks Jihei for the latest update and sharing on the market. Yes, the REIT market has been going through a challenging time this year. And at the end of September or the October period, we have seen a good rebound in the REIT sector. So may I now invite Mr. Victor Tan to share with us the First REIT latest business update. Over to you, Mr. Victor.
Thank you so much, Sunny. Good evening, everyone. Thanks for taking time off. I know that this period of time is the festive season. I know that you all must be very busy shopping for Christmas gift. I'm really delighted that you are able to join us, in today's presentation. Okay, without further ado, I will dive straight into my presentation now. Okay, I think Sunny had did a very good job to give us a quick overview of First REIT just now. Maybe I'll just share a couple of points. We are the first healthcare REIT to be listed in Singapore Stock Exchange, way back in December 2006. We actually started with 4 assets in Indonesia, and then over the years, we have actually grown to 32 assets now, span across Asia, 3 countries. In Indonesia, still our biggest market. As of now, 72% of our assets under management is in Indonesia, which comprises 15 assets. 14 of them are hospital, and then we have 1 hotel and country club there. Japan is a new country. We just ventured into Japan last year, and now we actually have 14 nursing homes in Japan. 25% of our asset under management is in Japan now. And then over at Singapore, we have 3 nursing homes, which make up about 3% of our total asset. Okay, and our total asset as of now is about 1.15 billion Sing dollar. And our vision is to become Asia's premier healthcare trust. And our target is that we want to have 50% of our assets under management to be in developed market by FY 2027. Of course, developed market, we are talking about Japan, Singapore, and other developed market. Maybe I'll cover later on my slide. Next slide. Okay, a quick note on our sponsor. Since 2018, we actually have a new sponsor. Okay, our new sponsor is actually OUE and OUE Healthcare. Okay, First REIT is actually managed by First REIT Management Limited, and the manager is actually 100% owned by the two sponsors. Okay, 60% by OUE Limited, and then the other 40% is by OUE Healthcare Limited. Okay, as of September this year, the sponsor combined stake in First REIT unit is about 44.6%. Okay, I think you all may be very familiar with these two sponsors. OUE Limited is actually a leading real estate and also healthcare group. They basically is a company that involved in development, investment, and management of real estate asset across the commercial, hospitality, retail, residential, and healthcare sector. Okay, and OUE total asset was valued at about 9.5 billion as of December last year. And of course, their healthcare arm, OUE Healthcare, is actually a service provider that operate and invest in quality healthcare businesses in high growth market, which include 2 hospitals in China and also operating a couple of hospitals in Myanmar. Okay, the other notable shareholder is actually Itochu Corporation. Itochu is actually is listed on Tokyo Stock Exchange and is among one of the larger and most diversified trading company in the world. Itochu owns close to 20% stake in OUE Healthcare. Okay, this slide I just wanted to talk a little bit about our leases. Due to the nature of our asset, healthcare asset, mainly hospital and nursing home, our leases are all very, very long dated. They can range from 10 years to as long as 30 years. Okay, hence our weighted average lease expiry is very long, 11.7 years, and our committed occupancy is 100%. Okay, but if you look at the asset that's within our portfolio, each individual asset, the occupancy, underlying occupancy of asset is between 60 to some even 90%, especially our nursing home in Singapore and also Japan. Okay, I will just go into the leases for the 3 countries. For the Indonesia side, of course, we receive our rental income in Indonesia rupiah, and there will be a base rent, and every year there will be a 4.5% escalation on the base rent. And then on top of that, there is also a performance-based rent. Okay, this performance-based rent is based on the 8% of the preceding year, financial year of the gross operating revenue of the hospital. Okay, and we take the base rent, which is going up by 4.5% annually, against the 8% gross operating revenue of the hospital. We compare on hospital by hospital basis, and whichever is the higher number, we will take the higher number as our rental for the particular year. Okay, and the leases for the Indonesia asset are all on triple net basis. What I mean by triple net is that the operator will take care of the daily upkeep of the asset, and they will also pay for the insurance of the property and also pay the property tax. Okay, and the leases for the Indonesia asset are 15 years with option to renew for another 15 years by mutual agreement. Okay, and then if you go over to the Japan side, the leases for Japan are all very long dated. It's be either 20 years or 30 years. Okay, and of course, for Japan side, we receive the base rent, and the rental may be revised upward upon negotiation for every 2 to 3 years for 12 of our assets, and then for every 5 years for the other 2 nursing homes. And this negotiation is actually based on the increase in Japanese consumer price index and also the interest rate. And of course, in Japan, all the nursing homes there we receive the rental income in Japanese yen. For the Japan nursing home, there's only one nursing home we have received triple net. It's on a triple net basis. Well, the other 30 nursing home, we will have to pay for the insurance cost as well as the property tax. Whereas all the nursing home operator will continue to bear the daily upkeep or maintenance of the nursing home. Okay, over in Singapore side, base rent, and every year the base rent will be increased by 2%. And of course, we receive the rental income in Sing dollar. And out of the 3 nursing home, 2 of the nursing home is on triple net basis. Again, what I mean by triple net is that the operator will take care of the maintenance of the nursing home, insurance, as well as the property tax. Only one nursing home in Singapore, we are bearing the property tax for them. Next slide. Okay, post the restructuring of our rental in 2021, now we actually have a very diversified tenant base. Okay, now we have about 11 tenants mixed. And then notably, if you look at our Indonesia portfolio, now we actually have bring in the operator, Siloam Hospital Group, as our direct tenant. Okay, in the past, as some of you may know, we have to build the rental income for the hospital via Lippo Karachi, and Lippo Karachi has a sublease with Siloam to collect part of the rental from them. But post the restructuring, we are receiving rental directly from Siloam now, and as of current, we receive more than half of the rental coming from Siloam, and this half of the rental, it will increase to about more than 80% in the long term. Okay, what I mean by long term is that when all the hospital are able to enjoy the performance-based rent, that's where we will be able to receive more than 80% of our rental income coming directly from Siloam Hospital Group. And if you were to follow the Siloam Hospital Group result, you will know that Siloam Hospital Group has been performing very well post the pandemic. You know, they have been able to record very good double-digit growth on the top line and on the bottom line on a very consistent quarterly basis. Okay. Okay, a quick note on our 9-month financial. Okay, this is the 9-month financial that we reported a couple of weeks ago. Our rental income as well as net property and other income was quite flat, but the underlying performance of our asset, especially the Indonesia side, show quite a good number. Later, I'll come to that. The distributable amount as a result come off by 1.2%, and this was largely due to higher finance costs as well as the depreciation of the foreign currency against the Singapore dollar. Okay, and the total issue and issuable unit for this 9 months has increased by about 1%. This is largely due to the issuance of the unit as part payment for the management fees to the manager. Okay, and hence the DPU for this 9 months dipped from 1.98 cent over 1.86 cent, down by 6.1% again. The reason is actually due to the higher financing cost as well as the forex loss that we had for this 9 months. Okay, and we are still able to deliver a very consistent DPU for the 3 quarters for this year. Next slide. Okay, shared earlier on that we actually have a very healthy underlying growth. If you look at the Indonesia hospital, in terms of the local currency, the rental income in the local currency has actually gone up by 8.8%. Okay, I also shared earlier on that if you look at the lease structure that we have currently, it will go up by minimally 4.5% year on year. But we also have some hospital that is already receiving the performance-based rent, which means that for these few hospitals, there are 3 of them, they are receiving performance-based rent. Their increase is more than the 4.5% fixed escalation. Hence, you see that on the consolidated basis, we are able to record an 8.8% growth in terms of our rental and other income from the Indonesia side in the local currency term. Okay. On the Japan side, although it shows that we have gone up by 42%, but we are not exactly comparing like to like, because if you look at the Japan nursing home, we only acquire the Japan nursing home sometime in last year. 12 of them we acquired in March last year, and then we add on another 2 in September last year. Hence, we are not showing a full quarter rental income for last year. So this quarter, these 9 months, 2023, we are showing a full quarter. So we are not comparing like to like. Hence, this 42% is not the true 42% increase. Okay, our balance sheet continue to be very healthy. If you look at our total asset, it dipped slightly, and this is actually due to the depreciation of the Japanese yen against the Sing dollar. And if you look at the total liability side, it has gone up slightly. Hence, our total unit holder fund is still healthily at about 628 million, and our net asset value is about 30.3 cents. Okay. Next slide. Okay, our net maturity profile as well as capital management files. Our total debt as of this September is about 466 million. Our gearing is about 39%, and our weighted average term to maturity is about 3.8 year. And this is because in June this year, we have actually completed an early refinancing of our TMK bond. This is a Japan loan that we have. This is supposed to be due in May 2025, but we have to do an early refinancing, and we have actually pushed back the expiry date of this bond to 2030. Okay, hence we do not have any refinancing requirement until May 2026. Our all-in cost of debt has crept up to about 5%. This is largely due to the, when we refinance this TMK bond in June, we have also decided to fix the rate. Okay, we have actually fixed the TMK bond rate, notwithstanding that BOJ Bank of Japan has not hiked the interest rate, but I think there's a lot of talk that they might have to hike sooner rather than later, and for about 20-25 basis point, we can actually fix the bond for another 3 years. So we have decided to take the step to actually fix the Japanese bond going forward. Hence, our percentage of debt on the fixed rate or hedge basis has actually gone up from about 59.6% to about 86% now. Okay, so only 14% of our debt are actually on floating basis, which will augur us very well. All this talk about higher for longer rate will have minimum impact on us. Our interest cover ratio is still about 4.2%, is still very healthy, still within the statutory rate of 2.5 times, in order for us to be up to 50%. Yeah. We continue to deliver quarterly dividend. In fact, we are one of the few REITs that pay dividend on a quarterly basis. So this is actually our slide that shows our quarterly dividend, our timetable. The third quarter dividend will be paying out in a couple of days' time. Okay, and our distribution yield is about 10.8%, still slightly higher than the SP's average of 8.2% that you heard early on. And our price to book ratio is actually 0.76 time, and I think this is actually based on the share price as at September. Our current price to book ratio will probably be about 0.85 to about 86 times. Yeah. Okay, maybe a quick few slides on the outlook as well as our growth strategy. Okay, outlook. I mean, healthcare asset is still a very resilient asset class with robust demand fundamental as well as long-term growth prospect. Just want to share a little bit of the market outlook in the three countries that we have our asset in. Japan, as you know that this is a super aged society. In fact, if you look at their population 65 years and above, currently 30%, 1/3 of their population is in the category, and it's projected to increase to about 35% by 2040. So there are currently about 10,600 welfare facilities for long-term care, and with 87 beds in Japan, average of 87 beds in Japan, this translates to about 922,000 space available. This is definitely not enough to cater to the population in Japan, population of about 130 million people, So definitely there are a lot of demand, for Japan to build more welfare or healthcare or aged facility, in time to come as well. And also another survey that we did is that 63% of the Japan household where a senior age 65 is receiving care. The caregiver itself is also a senior. So we are looking at senior is taking care of senior as well. And if you look at the Singapore side, Singapore not quite super age society, but we are also moving in that direction. As at now, about 18% of our population is about 65 years and above, and government is projecting that by 2030, 1/4 of our population will be 65 years and above. Then they also are projecting that Singapore will have to increase the nursing home capacity over the next 5 to 8 years by at least another more than 2,000 beds. And some of you may have known of people that experience a long wait, in trying to go to a nursing home. Hence, government is also looking at trying to cater more the assisted living sector, to help to build this gap at the moment. Okay, and over at Indonesia side, not quite aging population yet, but Indonesia at this moment, they are actually lack of healthcare or hospital bed. If you look at the hospital bed per 1,000 people, currently they only have 1.4 bed per 1,000 people, so is way below the ASEAN average of maybe about 2 point plus beds. Okay, and also since a couple of years ago, Indonesia has come up with the National Health Insurance Program, and this National Health Insurance Program has actually reached about 260 million people, or about 94% of the total population as at July this year. And this healthcare program will allow more people to be able to access to basic healthcare services or system in Indonesia, and this will drive a lot of demand for the healthcare service in Indonesia. At the same time, the middle to upper income household also expected to grow from about 39% to about 40+%, in the next few years' time. And that Indonesia last couple of years has grown economically average about 4 to 5%. As a result, there will be more middle income coming up from this group, and again, this will drive more demand in the healthcare services as well. Okay, since 2021, we have actually come up with the First REIT 2.0 growth strategy, and there are a couple of pillars in this 2.0 growth strategy. Of course, our main focus is that we want to diversify into developed market. We want to increase our portfolio in developed market to more than 50% of our asset under management by FY 2027. As of now, about 28% of our asset under management is already in developed market, Japan and Singapore. and we actually halfway through this target, and we are confident that within the next few years, more than 50% of our asset under management will be in developed market, and this will help us to be able to deliver more sustainable as well as stable dividend to our unit holder. And of course, besides diversifying developed market, we also want to look at how we can actually reshape our portfolio for capital efficient growth. And what I mean by reshaping portfolio is that we want to be able to recycle capital from our non-core asset or mature asset. If you look at our existing portfolio, we have a hotel and country club, which is actually a non-core asset for us, and we also have another hotel and also a couple of more that is within our portfolio is actually joined together with our hospital, and we are actually looking at the possibility of splitting the title, and if we are able to split the title, we also would like to divest this asset as well. Okay. And of course, as we continue to grow, as we go into developed market, we also want to look at how we can strengthen our capital structure by looking at some of the funding options so that we can continue to optimize our financial position. So on this front, we are able to successfully price Singapore First Healthcare Social Bond in April last year. Okay. And this year itself, we also have able to refinancing one of the TMK bond in Japan. Hence, there's no refinancing requirement until May 2026. Okay, and last but not least, we also want to continue to pivot to ride the mega trend, by improving the ESG, and also to ride on the opportunity in the aging demography as well as the under penetrated healthcare sector, which I shared earlier on in the previous slide. Okay, summary, I just wanted to state that the aging population in Japan, Singapore, and demand for quality healthcare in Indonesia will continue to drive our growth going forward. Okay, currently we have a very supportive sponsor, and their combined stake in First REIT is about 44.6%. Hence, there is great interest alignment, with the other unit holder. And post the restructuring, we also have a very sustainable rental escalation that is built into the master lease structure. Long weighted average lease expiry of about 11.7 years with 100% committed occupancy. And also 86% of our debt is already on fixed rate or hedge basis. And we also have lengthened our weighted average debt to maturity of 3.8%. And we do not have any refinancing need until May 2026. Also going forward, because the bulk of our asset is overseas, we will actively manage the foreign currency exposure by entering into some derivatives so that we can hedge our foreign currency exposure going forward as well. Okay, and of course, we target to achieve 50% of our asset under management in developed market by 2027, thereby reducing our geographical as well as tenant concentration risk, and this will hopefully help to increase our risk profile going forward. And as our risk profile improve in the year to come, hopefully our dividend yield will be more closer to the average S-REIT yield going forward. Okay, thank you. I think this is all I have to share. Maybe I will just open for time of Q&A. Yeah.
Sure. Thank you, Mr. Victor, for your insightful and very informative presentation. We will now move to the Q&A session. So feel free to put your questions in the Q&A chat box. We see some questions coming in, so do keep them coming. For our audience on Facebook and Moomoo, do click on the link to join us in Zoom so you can also post your questions over there. And we'll try our best to get to as many of them as possible. Mr. Victor, please stay on the line. We'll now proceed to the Q&A session. We have some pre-submitted questions. One of them is on the high interest rates. and the high financing costs that a lot of REITs have been going through this year. And Ms. Jihei just now shared that the projection is next year, the Fed might be cutting the interest rate somewhere in March onwards. So how has the interest rate impacted First REIT for the first 9 months of this year? I believe it has also dragged down the DPU as well. So maybe you can share a little bit more of that. And if interest rate were to subside or come down later on next year, how will that benefit First REIT?
Yeah, I mean, that would definitely benefit us going forward. But maybe I just wanted to share a little bit about how this high interest rate has impacted us. I think if you look at our 9 months number, it actually dropped by 6.1%, and this was largely driven by two factors. Of course, one of them is the higher interest rate. We have actually fixed our interest rate going forward. As of now, about 86% of our debt are on fixed or hedge basis. Okay, and some of these hedges will come off end of 2024. Okay, one part of it will come off end of 2024, and then the other part of it will actually come off end of 2025. Okay, so obviously, when the Fed start to cut the interest rate sometime next year, although there's a lot of speculation whether it will be first quarter, second quarter, or third quarter, but there's no certainty that they will cut in any of the quarter, but we are not going to speculate that. But what we did is that we are going to actually fix, we've actually done the fixing. At least 86% of our debt is already on a fixed rate basis, so that will actually help us to mitigate any potential increase, although at this moment it seems unlikely, but you never know what will happen, but at least we want to cover ourselves that if there's going to be any hike in term interest rate, that will not have a major impact on us. But of course, if the interest rate were to come off, we have some hedges that will come off towards the end of last year, and that will definitely benefit us, because once the hedges go off, we will not fix, and the debt will probably go on a floating basis going forward.
Okay, so good that we hear that the high interest rate has been looked into and mitigated. So that provides some of our unit holders some reassurance there should the uncertainty and interest rate continue next year. So I also looked at your key financials earlier on. Besides the rental and other income, which contribute about 81 million for the first 9 months, we also have the net property and other income, which accounts for 79 million. Would you like to elaborate the net property and other income, which also contribute a big bulk of your financials?
Okay, so Sunny, actually that is the same thing. Okay, the net property and other income, right? This is actually net of the property expenses. So if you look at our rental and other income and versus our net property and other income, it's actually quite identical. The net property and other income is about 95%, maybe 97, 90% of the rental and other income. This is largely due to the nature of our lease structure. And I shared earlier on that if you look at our biggest market at this moment is still Indonesia, and all the leases in Indonesia are on triple net basis, which means that there are very little expenses, there are very little property expenses. Hence, the bulk of the rental income will flow directly into the net property and other income.
I see. Okay, so they are actually both the rental income coming into First REIT, just that the net property goes through maybe some of your partners first before going to the First REIT.
That's correct. That's correct.
Okay, so we have a clearer picture there. So we also have a questions on the Q&A by I think by one of our unit holders, Mr. Chai. Over the years, the DPU has dropped and it's now starting to stabilize. With the interest rate that we talked about just now, what is your opinion? Is it going to turn and increase next year, or will we see that the drop might continue?
Okay, this year the DPU decline was largely due to two reasons. One of them, of course, is the higher interest rate. So going forward, the interest rate portion will be stabilized. The other factor that's contributing to the drop in DPU is actually the Forex. Okay, so what we're trying to do is that we are trying to actually hedge our Forex going forward. For instance, the Indonesian rupiah currency as well as the Japanese yen. Okay, so as of now, about 40% of our income coming from Indonesia is on a hedge basis. That means we already hedged 40% of our rental income coming from Indonesia, and we also have recently hedged about more than 50% of our rental income coming from Japan as well. Although Japan, this moment only contribute about 15% of our distributable amount, but I think it's good for us to also hedge, consider how volatile the Japanese yen can be. So one of the way for us to manage our or to stabilize our DPU is basically to enter into some of these forex hedge, which is what we are doing, and we are also monitoring the forex market very closely. Yeah.
Yes. So talking about the FX exposure and FX risk, which is one of the components that's affecting the DPU. Next year, the Bank of Japan is projected to increase interest rate and move away from their negative interest rate regime. So if there's an increase in Japanese interest rate and the yen is likely to strengthen, would that be a positive or a negative impact to First REIT in your opinion?
There will definitely be a positive for us because we have some Japanese yen in terms of rental income, and I also shared earlier on that we actually fixed the TNK bond, which we recently just refinanced. So even if Japan were to hike the interest rate next year, it will not impact us because we already fixed the bulk of our Japanese loan. Yeah.
Okay, so it's also very reassuring to hear. So interest rate in US comes down, we expect the impact on DPU to be lighter, and then the Japanese yen strengthening would also provide a more positive impact to First REIT as well.
That's correct.
Reassuring to hear. Okay, yeah. We have a next question on the Q&A by Mr. Agrawa. In slide 9, the difference in rental growth, what is the 100% committed occupancy? On the 100% of committed occupancy, is there some kind of agreement on this 100% occupancy that the First REIT has?
Okay, when I say 100% committed occupancy, is because this is largely due to the nature of asset, because ours are a healthcare asset, hospital or nursing home, and we only have a single tenant or single operator. And we actually managed to lease out all our assets. This is the reason why we have 100% committed occupancy. But the underlying occupancy, for instance, the underlying hospital or nursing home occupancy, which I shared earlier on, is between 60 to 90% or 95% for some of the nursing home. So that's a bit different. Okay, unlike if you look at some other asset class, for instance, the commercial, office, or retail, the occupancy will be very different because they have multiple tenants. Whereas for us, we only have a single tenant.
Okay, so understand that. So it's a committed 100%, but the occupancy of the hospitals or nursing home might be slightly less from
That's
there.
correct.
But that does not really affect First REIT because you have that 100% committed occupancy already.
Yeah, that's right. Because our leases is directly with the operator, so the operator will have to pay us the rental. Of course, we also hope that the operator do well. Hence the underlying occupancy is also important to us. But they will not affect us because our leases is directly with the operator per se. Yeah.
Yeah. So First REIT is actually doing the due diligence to make sure that the operator is doing well, the occupancy rate is high, so that it will not in any way affect the 100% committed occupancy to First REIT.
Correct.
Okay, thanks for that clarification. We also have another question on the Q&A from EJ Lee. First REIT rental restructuring exercise, share price and unit value has been coming down, not really recovering, but of course very stable right now. Is the management doing anything to restore investor confidence and share price?
Yeah. Okay. Post the restructuring, right? We have been saying that we want to be able to deliver very sustainable as well as very stable growth, and this is actually what we are doing post the restructuring. And of course, we need to have a plan. This is the reason why we come up with a 2.0 growth strategy. With the 4 pillars that we have set in place, and now we are actively focusing and pursuing this growth strategy, so that in time to come, hopefully we will be able to continue to give out very sustainable as well as very stable dividend going forward. Yeah.
Yes, so just like to add on to that, Mr. Victor is also very active in answering an investor's question on his LinkedIn. He usually met up with reminders, with analysts, and then giving his view on giving updates of how the REIT is doing. So you can, I'm also his follower on LinkedIn, so you can also check him out on LinkedIn to share his latest update as well. So I think that will answer a bit of the EJ question over there. Okay, next we have a question on divesting non-core assets like the golf course and hotel shopping malls that you mentioned earlier, Mr. Victor.
Yeah.
So, what are the reasons and why such plans are not materialized yet? Would you like to share a bit more?
Okay. For instance, the hotel and country club. Okay, this is actually one of the assets that stand alone. Okay, the land title is stand alone, so we do not have problem with the land title. It's just that for the past few years, the property market in Indonesia hasn't been doing that well. And also we have actually talked to a couple of interested buyer, and these are all third party buyer. We have actually shown quite keen interest. So we continue to discuss with them, and we are also talking to the authority to actually seek for some approval permit. Okay, so we are actually working on that. So the delay is actually on the approval of the working permit. So once we are able to sort out all the regulatory requirement, I think we should be able to divest this hotel and country club. Okay, and then for the other two more and the other hotel that I shared earlier on, they want, because currently these three assets is joined together with the hospital. And what I mean by joined together is that they actually share the same land title. Okay, so we are looking at the possibility of separating the land title. If you are able to separate a land title, we will be able to divest it, because at this moment, it's a bit challenging for us to divest, because it's on a same land title, unless you are prepared to actually sell the hospital as well.
I see. Okay, so the second part to that question is that you mentioned you are waiting for the regulatory approvals, which you mentioned earlier. So is there any timeline that you are looking at, like 3 months or 6 months later, you might be able to
we
get?
are looking at sometime middle of next year.
Middle of
next year, middle to, or at least probably second half of next year. Yeah.
Okay, so if you have updates on that also, do share with the.
Of course. We will definitely make the required announcement as and when there's any update on our divestment.
Thank you very much, Mr. Victor, on that. And we have another question from Mr. Chong Wei Long. Some of the REITs in Singapore, they have some outstanding rental that they may not have collected yet. On First REIT side, is there any outstanding rental that is still outstanding right now, and any potential default risk that you foresee?
Yeah. There's actually one rental outstanding, from one of these third party tenant called PTMPU. Okay, so we are following up very closely with PTMPU. Okay, this particular company is a asset rich but cash poor company. Okay, they have a lot of asset, a lot of land bank. Okay, so what we understand is that they are in the midst of divesting some of the asset that's within our portfolio. So they should be able to raise some cash to pay us. And we don't foresee that it will be a default. We probably just need to give them a bit more time for them to resolve this. And I'm confident that we should be able to get them to pay us the outstanding rental sometime early part of next year. Yeah.
Okay, so that will answer Mr. Chong Wei Leong's question that First REIT actually actively trying to get back the outstanding rental, and it's because that this is their PTMPU is actually a asset rich company, I would say, so that they will need some time to raise the cash to pay the outstanding rental. So the default risk here is not high, it's looking low over here. Okay, so the next question we have, you mentioned earlier the issuing of the social bonds. So Chris Lim over here has a question on what is the cost and requirements for issuing these social bonds for First REIT?
Okay, the social bond that we have is a bit unique because this require the company to have, or the REIT to have social asset. It so happen that, if you look at the asset that we have in the portfolio, these are mainly hospital, nursing home. This is considered social asset by the definition. Okay. So this is the reason why it's very unique. We have this opportunity to be able to tap on this social bond because of the nature of our asset. Okay, but this is a bit different from the sustainability link note or link loan that maybe the market is more familiar with. Okay, of course, we also have the same KPI. We also need to achieve the same certain similar target or goal. But I think for those sustainability link bond or link debt, they do have some economic benefit in the sense that their interest rate and there can be some saving in their interest rate. Whereas for our case, we do not have this interest saving. But nevertheless, we are able to have the opportunity to tap onto this social bond, largely because of the class of asset that we possess. Yeah.
Okay, so it's another avenue to tap on some of the funding.
That's correct. Yeah.
That will provide another funding opportunity for First REIT as well. So that gives investors some security over there. Next, we have a question. First REIT do have significant exposure to countries with currencies of a consistent depreciation against the Sing dollar. Or if I put it in another way, Sing dollar might be too strong for the other countries' currency. So you mentioned about how you have been hedging this. Anything to add on to Mr. Xiao questions here that we have?
Yeah, I mean, we are fortunate that post the restructuring, right? When we actually switched to Indonesian rupiah, I believe this is what you're talking about. Indonesian rupiah has been very stable for the last 2 to 3 years. Of course, it started to experience a little bit of weakness maybe about 6 months ago. Of course, one of the factors is because Sing dollar is really strong, compared to most of the business. So what we also intend to do is that this is the reason why we want to diversify into developed market. So we also did some study that the currency for developing country versus developed country, there's this negative relationship. Okay, what I mean by this is that depreciation currency, if they depreciate, the currency in the developed market will tend to appreciate. So there is a bit of natural hedge if you have some asset in the developing country as well as some asset in the developed market. Okay, so that's what we intend to do. Of course, we are also open to divesting some asset in Indonesia as well. This is the reason why I say that one of the pillars for our 2.0 growth strategy is that we want to reshape our portfolio. Besides looking at divesting our non-core asset, we are also open to divest our mature assets. So we're also open to selling some of our assets in Indonesia so that we can channel the fund to the developed market. So that will also help us to reduce some of the forex exposure in the developing country. Yeah.
Okay. On this topic of the developed market and developing countries, so will you want to be specific in sharing which are the developed markets or developed countries that you will be or the First REIT is looking at right now?
Okay. At this moment, we are in Japan and Singapore. This is the developed market that we are in currently. Another developed country that we are actually looking at is actually Australia. Okay, I think I shared this a couple of times in some other forum, in some slides as well. So we're also actively looking at asset in Australia, and definitely Australia will be another market that we'll be very keen to explore as well. Yeah.
Agree. So the silver market in Australia is also growing as well. That will be one of the developed markets that First REIT can be looking at as well.
That's
okay.
Right. That's
yeah.
right.
So we are about 1 minute to 8 o'clock. I will just sum up the rest of the questions. I think most of them are the outlook of First REIT. So you mentioned that we have 3 nursing homes in Singapore. And we also have an aging population here in Singapore. Are there any immediate plans, or you may be aware of that we might First REIT will be expanding the number of nursing homes in Singapore?
Yeah, I mean, we definitely are very interested in adding more nursing homes in Singapore if we can, but unfortunately at this moment there is not many healthcare asset that's available in Singapore for us to look at, So, but of course, if there are opportunity for us to add more healthcare assets in Singapore, definitely we will jump in at the opportunity. But at this moment, I just wanted to say that we are not looking at any nursing home in Singapore at this moment. Look like we will have to look somewhere else. Yeah.
Yes. So Singapore is too small, maybe a smaller market. So you are saying looking elsewhere. So how about Malaysia, China, or Hong Kong, or that will you be looking at those areas as well?
I think I just wanted to focus on developed market at this moment because this is one of our key strategy going forward. I'm not sure those markets that you mentioned earlier fit into our portfolio at this moment, but of course, China is definitely a big market, for us not to ignore in time to come. But and also our sponsor is operating two hospitals in China, and they'll be opening up another one sometime next year. So they will have about 3, or in time to come, they will have more hospitals in China. So China, definitely we can look at it, but not within the next few years. I think the next few years we will like to focus on Japan and maybe Australia. And of course, if Singapore, the opportunity, we will definitely look at as well. Yeah.
Okay. So thanks for sharing those insights with us on looking at the Singapore market, healthcare market, as well as the Asia market that you are looking at. So the time now is 2 minutes past 8 already. I'd like to thank Mr. Victor for sharing so much with us today that help to update the unit holders on the latest development in the First REIT development. So we still have a lot of questions in the Q&A. Unfortunately, we don't have enough time to go through all of them. But if you have any question, please feel free to post it to the IR for First REIT. Their email is ir@first-reit.com. You can also check out their website, first-reit.com, or their LinkedIn page. So, Mr. Victor, I'd like to thank you today for your sharing. We hope the unit holders that are joining us today found this Corporate Connect session useful. In case you've missed any part of today's session, you may also rewatch this webinar on our SIAS YouTube channel. Corporate Connect is our monthly webinar, so do visit our SIAS website to get more updates on our upcoming investors education program and initiatives. You may also type in the chat box to let us know which companies you would like us to feature next. We hope to see you for more of the Corporate Connect session in 2024. And Mr. Victor, thank you for joining us this evening. We'd like to wish everyone happy holidays and have a great year ahead in 2024.
Thanks, Sunny, for having us. Before I leave, I just wanted to wish everybody a blessed Christmas as well as a joyous New Year, a good year in 2024. Thank you so much.
Thank you, Mr. Victor. We hope to see you more often next year on SIAS as well.
Thank you.
Thank you.